I'm Craig Popp with Accrue Wealth, and this is Charts That Matter. Today, we are going to take a few minutes to talk about what happened in the markets in August and what it could mean for your portfolios going forward. Let's start with the market highlights. So first, the big headline. Stocks hit all-time highs in August. Year to date, the market has now registered 20 new all-time highs. It's below the pace of 2024, but more in line with typical bull markets. Bonds also had a strong month. That's a pretty solid outcome, especially given all the uncertainty we're still facing. Things like tariffs, Federal Reserve policy, and some concerns about the tech sector. The month started off a little rocky, with new US tariffs kicking in after a 90-day pause. Then, a federal appeals court ruled that these so-called reciprocal tariffs are actually illegal. Mid-month, markets dipped a bit on worries that the Fed might keep interest rates higher for longer to fight inflation. But sentiment quickly rebounded thanks to strong corporate earnings and growing confidence that the Fed could start cutting rates as soon as September. When it comes to the economy, the numbers were a bit of a mixed bag. GDP growth for the second quarter was revised up to 3.3%. Which is a strong improvement from the first quarter's slight decline. But on the jobs front, we saw only 73,000 new jobs added in July, and previous months were revised lower. That led to the firing of the head of the Bureau of Labor Statistics, which added even more uncertainty. Still, despite all this, volatility remained low compared to historical standards, which is pretty remarkable. Here's a quick snapshot of how the major indices did. The S&P 500 rose 1.9% in August and is now up almost 10% year to date. The Dow Jones Industrial Average gained 3.2% for the month, while the NASDAQ rose 1.6%. International markets were strong too. Developed markets jumped 4.1% and emerging markets gained 1.2%. The bond market rallied with the Bloomberg Aggregate Bond Index up 1.2%. Meanwhile, Bitcoin fell, gold hit an all-time high, and the US dollar weakened slightly. So what's really driving the market? It all comes down to corporate earnings. Nearly 81% of S&P 500 companies beat expectations during the second quarter earnings season. That's the highest percentage we've seen since late 2023, which shows that many companies are still managing to grow profits, even with higher cost and policy uncertainty. A lot of attention was on the so-called Magnificent Seven mega cap stocks. Their performance has had a big impact since they now make up over a third of the S&P 500. Results were mixed, but strong enough to help fuel a late month rally. As we start looking ahead, you might be wondering, what's the Fed going to do? Fed Chair Jerome Powell made it clear in a recent speech that the Fed might resume cutting rates, especially with signs that the job market is cooling off a bit. The Fed has a dual mandate: keep inflation in check and maintain low unemployment. If job growth continues to slow, the case for rate cuts gets stronger. And rate cuts, if they happen, could be a positive catalyst across many asset classes, from stocks to bonds. For bonds especially, falling rates means higher prices and better total returns, especially for those holding higher yielding bonds issued earlier. Here's the key takeaway. Even with all the noise, tariffs, Fed uncertainty, job market data, the markets are being driven by strong fundamentals. Companies are still earning money. Inflation seems to be easing, and the Fed might soon provide additional support. For investors, the message is clear: stay balanced and stay long-term focused. Trying to time every policy change or economic headline can be a losing game. Instead, Having a well-diversified portfolio that includes both growth and income sources, like stocks and bonds, can help weather the ups and downs and keep you on track towards your financial goals.